You're entering CNBC TV 18's virus-free studio, powered by Century Laminates and Century Ply.
Good morning. You're with us here on a fresh new edition of Trading Hour, 11 o'clock this Monday morning. Markets are up and up, 110 points higher on the Nifty. Banks, once again, after having a down week, the last one, are up 2.5%. So it's very clear where bulk of this push is coming from, and why not? HDFC Bank, of course, reported numbers, and the numbers in the environment that we saw in the second quarter are super strong, and that's kind of lit a fire under most other banking stocks. Not just, the large bank names like ICICI or Axis, but even, names like Bandhan Bank, etc., which are participating. So the financial space basically is what is leading this move. A little bit of come off. 100 points now on the Nifty from being up 120 5 or 10 minutes back, but we'll see how things progress. Just 2 weeks or so to go for the US elections, and that's going to be the big one. And that's at a global level what really holds sway. But what we've seen in terms of data and numbers so far has been very encouraging. With me, my colleague Reema Tendulkar. Hi, Reema.
Hi, Prashant. Good morning. Well, globally, the three key buzzwords are politics, policy, as well as pandemic. Let's see how that plays out. But as you rightly pointed out, it's all about the banks, and banks. HDFC Bank's earnings have now put the spotlight on ICICI Bank and Axis Bank. Both of them will be declaring their earnings next week. And I was just taking a look, that the Nifty's practically back at the 12,000 mark. It hit it last week. But the Nifty Bank has been a rank underperformer. We've been talking about it, right? The Nifty, the last time the Nifty was at that 12,000 mark was on the 24th of February. If you compare the Nifty to the same Nifty Bank to the same time, it's down 20%. And in that period, HDFC Bank is flat, and Axis Bank is down 35%, and an ICICI Bank is 25%. So Axis and ICICI Bank have been rank underperformers. And if HDFC Bank's earnings are anything to go by, the strong are just getting stronger, the big are getting bigger. People are going to be, looking at Axis Bank and ICICI Bank. And I think some of that, catch up seems to be taking place in today's trade. So after a long period of underperformance, there is some outperformance which we're seeing in the banking stocks for the last 2 weeks. So on a month-to-date basis, while the Nifty is up 5.5%, the Nifty Bank has rallied in excess of close to about 12%. So that's where all the action is in today's trade. But let's drill it down to individual stocks, get in some sense about the markets and the way forward. Vikas Khemani now joins in. Vikas, morning. What did you make of HDFC Bank's earnings? Would there be any read-through for an ICICI Bank or an Axis Bank or any of the other banking names?
They were super results. There's no question on that. Of course, while they are indication of what could be in offering for other banks in some sense. But having said that, HDFC Bank has always been standing out in terms of comparing their own results. Great part, I think, what I liked about in HDFC Bank results for the credit growth. Probably other banks might not see that kind of credit growth. I think one can see some sense of get some comfort from a trend point of view that banking sectors might not have as much an issue as being researched. But we will know clear picture only once the moratorium gets lifted and maybe a quarter down the line. But having said that, I'm not very worried. I feel that banking sector offers from a medium-term to long-term perspective a very good risk reward because I think most of the credit cycle is behind on the corporate side. Retail is right now being a bit of worry, and I guess that should be behind in for a couple of quarters. And good part is that most of the banks are well capitalized to that extent it offers comfort.
Vikas, morning. The difference between performance of HDFC Bank, I'm talking about stock performance, or ICICI or an Axis is just tremendous, right? And the numbers kind of show us why HDFC Bank is trading where it is, and the bounce has been so much stronger. So stick with that one name as, if you had to have, one large core banking holding, would it be HDFC Bank still?
For us, our large core holding is ICICI Bank for the simple reason I think there's a lot more catch up to be done. We are seeing in the last couple of years under the leadership of Mr. Bakshi, Bank has done a lot of things. So bank is kind of, in our opinion, leapfrog from here. So from a risk return, both franchises are very good. But from a risk return perspective, we think that ICICI Bank will deliver much better than HDFC Bank, and also market will watch out, being one of the most owned stock, how the leadership transition happens in HDFC Bank over next 3, 4, 5 quarters. I think to that extent, probably market will be a little muted on the buying further into HDFC Bank. To that extent, we remain more positive on banks like ICICI Bank.
And what would be, I mean, so ICICI is your top core holding. What would be the second name in that space? I mean, could be non-bank, but in the financial space.
I mean, from our perspective, we've been quite positive in that credit space. So we own Kotak Mahindra Bank. We think housing finance is a very, very solid space where the rates have come down. Demand is about to pick up. We are seeing activity pick up in the real estate. So we own LIC Housing Finance, which is a great risk reward according to us if you were to hold in 3 to 5 year perspective. So some of these financials names which we own, and we think balance sheets are very, very solid. Their business models are solid, and currently amongst the credit-oriented financials, we like ICICI Bank, Kotak, and LIC Housing Finance. From a non-credit perspective, we've been holding ICICI Lombard, which is again a structural growth story over the next 4 or 5 years, and maybe even longer. We are holding Reliance Nippon Asset Management, which is again a structural story. So we've been, and also we are holding Max Financial, which is the very last story again in the insurance space. So combination of all these things gives us a reasonably good exposure to the structural growth drivers in the economy on the PMS space.
Vikas, midcaps have started underperforming. What does that tell you about the way forward?
So I think we saw a sharp run up in them, in the recent past, and right now we are also staring at a bit of risk in terms of US elections, and as well as the second round of increase in the corona cases. So I think one is not sure whether will it really lead into a second wave of pandemic. Will it really lead into sort of a second kind of lockdown situation? So to that extent, I think probably the participants would try to avoid mid cap or small caps, because that is where you suffer the illiquidity risk the most. So that's the time, if suppose something were to change, you want to get out and want to reduce this exposure. Mid caps and small caps don't offer that. So I think most of the participants would right now have more exposure towards the large caps. And that is what is explaining the current situation. I'm sure once this hump of with this, which is over the next 1 or 2 quarters is over, then I guess mid and small cap will come back into favor.
Yeah. Vikas, I mean, very counterintuitive, but what we are seeing is that real estate sales, right? I mean, in certain pockets seem to be doing well. Now, this could be just bunched up demand coming together in 1 month, showing up in one particular project launch, flats getting sold, etc. Any thoughts on that? Because I've seen actually 2 or 3 different notes from the sell side talking about why that should do well. I mean, you already said you own names like LIC Housing Finance, but do you also own real estate company stocks in your portfolio?
So we believe that real estate is a structural theme over the next 5-10 years. For the simple reason, post-implementation of RERA, I think the whole characteristic of the structure is changing, or the sector is changing. You are seeing now big players will be growing bigger. People who have ability to borrow money at cheaper rate, ability to buy land at a cheaper rate, and ability to execute and sell to the customer. So I think it is clearly in favor of large and organized players. So that's a very big change. Second very big change that has happened is we underestimate the significant drop in the interest rates. We have seen interest rates dropping on housing loans from 9% to almost close to 6.5%, some 7%. So this 2-3% drop in the interest rates have a huge impact on the EMI, and thereby increasing the purchasing power of the consumer. And thirdly, post-pandemic, we are seeing the work from home culture picking up, and that will also require people to have little bigger houses. So that's also kind of creating a new demand into the ready to sort of move in houses. So what we are seeing is a significant sort of pickup in the ready to move in houses across the globe. That's where the inventories are going down. So that's a short-term sort of view. But from a longer term perspective, we think that there will be 8-10 large companies which will become very, very large in the market cap of the country, because this is the one sector where the need is definitely there. A very, very fragmented sector. And you could see this so over a period of time getting consolidated in a period of large and good quality players.
The stamp duty cut in Maharashtra, of course, is also aiding the sentiment when it comes to real estate sales in Maharashtra. But because there seems to be some interest which is now coming back in two-wheeler, the numbers are looking good in terms of sales. There is optimism that the shift towards personal mobility will first benefit the two-wheelers ahead of the four-wheelers. Do you like any of the names, or how are you positioned over the medium term on these stocks?
So I think, clearly, definitely automobiles, we have seen robust numbers coming out, and automobiles in the last 2-3 years have not done well. So to that extent, we have seen, this is coming out based on the back of a very, very low or poor base. So we've been quite positive on the mobility space. We will see over the next 3, 4, 5 quarters things doing well. We saw this quarterly numbers were very robust, and I don't see any reason why this will be any different. And that's where I think if you see overall, probably it can give you some sense on the overall market also. That you are seeing real estate kind of sector doing well, automobile kind of sector doing very well. Consumption has been quite strong. IT has come back very fast, rapidly. Banking we seems to be talking about now again good recovery. So if you see, all those things are pointing to one direction where markets and economy can do very well, and the whole narrative of the market you will see changing over the next 3-4 years. I think only thing probably participants are worried about the risk of the US elections in the second wave of pandemic. Once these kind of concerns cease, you will see a fairly robust equity environment over the next 3 to 5 years. That's our core belief.
Vikas, it's a pleasure. Thank you very much for joining us and running us through what you are making of things. Thanks indeed for being with us here on this edition of Trading Hour. The market is off, 35 points off the highs. We're at 11,855. The Bank Nifty was up 2.4% actually when we started. So it's up 2.2, just under 2.2. So there is a bit of pullback which is underway as we speak. So more color on markets, etc. in a bit. Market breadth, of course, still comfortably higher. 1,005 stocks are higher, 685 stocks are lower. That's the picture on the NSE. We'll come back and as I said, we'll tell you what is down and what's probably coming off a little bit as far as stocks go. We also have the commodities picture with Manisha Gupta joining in, and she's got sugar prices in focus today. Back in 2.